we have a professional real estate photographer come into every unit and make the place look amazing. And studies have shown that homes with professional real estate photography sell for 5 to 10% more and rent for 5 to 10% more.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 204. My guest today has figured out a way to make rental property ownership easier and more profitable. And he's here to share his approach to making money and building wealth through rental properties. David Friedman is a Boston-based real estate entrepreneur, and he's the founder of Knox Financial, which is focused on helping people convert their homes into rental properties and managing those properties for them. He's also written several articles for Forbes.com with advice for landlords that I know you will all benefit from. David, thanks so much for being on the show today.
Oh, it's great to be here. Thank you.
So why don't we start with you just telling us a little bit about yourself and how you got started investing in real estate?
You know, it's a funny story. I was an undergraduate. I went to Tufts University just outside of Boston. And I lived in a two-family for my junior year, my senior year, and my first year of grad school. And I think when I moved in, I was pretty naive about real estate. I mean, most people are at 20 years old. And I watched my rent go up almost 50% in 3 years. And when I moved out, the people who moved in were paying more than 50% more than I was 3 years earlier. I then got sort of hip to what the home was actually worth. I realized I was living in $1 million house that was worth about $500,000 maybe 7 years earlier. And the owner was making money hand over fist. So I said, well, what the heck? Why am I paying somebody else this rent? Why am I not the owner being paid rent? And I went out and started looking for a building like that to buy. By the way, I had been a carpenter when I was 17 and 18. So I said, all right, I'm going to buy a multifamily. I'm going to live in it. I'm going to do the maintenance myself. I'm going to rent out 4 or 5 or 10 other bedrooms, and I'm going to live there for free and make money, and it's going to grow in value. It's going to be great. Well, that turned out to be a big challenge for a guy this is a few years later, I'm finishing grad school. And what I ended up buying was just a 2-bedroom condo. And I rented out the other bedroom. And even that economically was really helpful because not only was I making money on the rental of that other room at market rate, but I also split all my bills. So I was paying half a cable bill and half a heating bill and half a lighting bill and all that good stuff. So, I kind of consider that my start in real estate investing because I had a tenant from the time I was 23 in that condo with me until I sold it over 10 years later.
Not only are you a real estate investor, but you're also an entrepreneur. Talk a little bit about that. How do those two things combine?
Funny enough, incredibly closely, because, one would not have happened without the other. When I bought that 2-bedroom condo, I struck up a relationship with a realtor with whom I've now done, 10 transactions or more actually. And he and I are friendly to this day. He helped me buy that condo. And while we're looking at properties, he says, I've got these computer problems. And I was an engineering graduate student at the time. And I said, I could probably help you with some computer problems. What do you pay? He said, my IT guy, he won't call me back. I think he's tired. He's moved on or something like that. And I said, well, what do you pay him? And he was paying him what sounded like a lot of money at the time. It was probably $60 an hour, $75 an hour, or something like that. I said, well, I'm sure I could fix your computer for $75 an hour. And sure enough, I ended up working for this realtor and a bunch of other realtors, helping them fix their computers. I'm going to try to make a long story short. I ended up launching a company around that, which at first was an IT company and for the real estate brokerage world, and then became a software company for the real estate brokerage world called Boston Logic. So that company grew over a decade to become one of the largest providers of software to the real estate brokerage industry. In 2016, I sold that company to a private equity firm, and we now own 6 different pieces of software, all for realtors and real estate brokerages. We have offices on 4 continents and clients in 75 countries. So, and we stopped doing IT consulting probably year 3 or 4 and became a software company. So that's a long arc condensed into a 1-minute explanation.
So for the brokers or realtors that we have out there listening to this, I'm sure they're wondering, well, what is that software and what was the application?
I can tell you where we started and where it was at the end. In the beginning, we were building solutions, sort of point solutions. So we built a property search platform. It was the first search that realtors could license or brokerages could license that involved mapping. This is back in like version 1 of the Google Maps API. We could put a map, results set on a map. Now that's everywhere, right? Yeah, that's probably the default way of looking at properties when you search for homes, whether for sale or for rent. We then we built a solution for rental inventory management. We built a solution for tracking clients, and then we combined those all into one platform. What that grew into was a sales and marketing system for a brokerage. So everything from the earliest contact with a client on a website, which would run on the platform, or by email, because we email marketing built in, through a client tracking system, all the real estate data componentry you needed. And now these days we have transaction management and a whole bunch of other pieces of software in the package. So that company is now known as Property Base. And if you're looking for the software to run your brokerage, Property Base is the company to call.
Wow. Okay. So that's quite an impressive background you have, and bring us current to today. Where did you go after you sold your business?
When I sold it, I stuck around and I kept working as CEO with the private equity firm who owned the vast majority of the company. I still sit on the board actually, and they've got a great management team in there. And we've continued to acquire other software companies in the space with the backing of a good banking partner and this large private equity firm known as Providence Equity. So after doing that for a while, I moved on and started a company called Knox, which is I'm now the CEO of Knox Financial. And the story of Boston Logic is intertwined with the founding of Knox in the following way. That unit I talked about a few minutes ago, that 2-bedroom condo in the South End, I owned it for 10 years. And while I was living there, I met my now wife, and we got engaged, and we decided we each owned our own homes, and we couldn't fit all of our stuff in either one. And neither of us wanted to sell all of our stuff, so we just needed more space. So we set out to buy another home, and we did. And it was time for me to sell my condo in the South End, which I'd owned for 10 years. And in that 10 years, it got up in value $250,000, which, if you owned a 2-bedroom condo in the South End for that 10-year arc, pretty much everybody made $250,000. It was just a really nice time in the appreciation of that market. Well, I was moving out and I said to myself, this has been my best investment. Why would I sell my best investment? This is silly. But, I had a day job. I was running this company and I needed to focus on that startup. I had employees and customers and investors counting on me to keep my focus on that company. And that's what I did. I sold the home and sort of didn't look back for a little while. And a year later, I was having lunch with that realtor friend. And he said, hey, that home in the South End you sold? It's now worth another $100,000. And I said, what? He said, yeah, the market's been going crazy. I'm like, I thought I did pretty well. Well, sure enough, 4 years after I sold it, it sold again and it got up in value $200,000 more. So I owned it for 10 years. I net $250,000 and I think I'm on top of the world. But now, 4 years later, I feel like a fool. I feel like the guy who made the worst investing decision of his life when he sold his best investment. And so I started telling the story to all sorts of people in a self-deprecating way. And I said, geez, what an idiot I am. What a bad investor I am. Look, I sold this investment that was performing. And sure enough, I missed out on the future performance. And it seemed like everyone had the same story if they'd owned property and sold it. They all looked back and they regretted it. And a lot of them had thought to themselves, what would it take to turn this home into an income property? And even the thought experiment stressed them out. Just, okay, how am I going to do, what about insurance? What if somebody slips and falls? How am I going to find a tenant? I need a plumber and a carpenter, and I need all these people on call. I don't have them. What is would I have to draw up a lease? Do I need a lawyer? And they threw up their hands and they missed out on a great investment. And one of the people I chatted with told that story to was Spencer Taylor. And he had the exact same experience. And this is, again, while we're running Boston Logic. And fast forward a little while, Spencer becomes the co-founder here at Knox, because we believe there are an awful lot of people who would, if they had the opportunity, keep the home they already own as an investment rather than sell it. And that is sort of the intertwined founding story of Knox and the story of Boston Logic.
Yeah, they would rather keep the home, but they don't want to put in the work to actually manage it or go through the steps that it takes to turn it into a viable rental.
The work is a huge part of it. Absolutely. The other part of it that people overlook a little bit is there's any number of unknowns in choosing to become a property investor, especially if you're not familiar with the inner workings of the housing market, the mortgage market, the insurance market, et cetera. Heck, the housing laws of your state or your town. All of these become sort of voids in people's knowledge. And those voids lead to risk. They lead to a perceived risk with the investment. And that also keeps people away. So A, I don't want to take on the burden. B, there are so many unknowns that I don't want investments. Nobody wants to invest in things they don't understand. They want to invest in things they fully understand and can grasp and feel like they actually can operate or manage or think about in a way that makes sense to them. When there are so many gaps in their knowledge, they just sort of throw their hands up and say, "Nah, I can't do that." And we've eliminated all that with the Knox platform.
Yeah, how so? What's the difference between Knox and a traditional management company? What system or formula have you come up with that makes it any easier on a homeowner than what's already out there?
The things that a traditional property manager delivers, we deliver. We just deliver a whole lot more. And then we've also changed the economic structure of it. So I'll get to that in a second. Anybody who owns income property knows that a property manager is not all you need to turn a home into an income property and then operate it. You need bookkeeping and accounting. You need legal. You need insurance. You need financing. A property manager, can be awesome, and they can handle your tenant and collect your rent and answer the phone when there's a leaky sink or there's a problem with the home at 2 a.m. And that's a wonderful service, but it's not everything you need. So Knox includes all the other stuff too. And we can say to our clients, you put the home in our program, you continue to own it, you hand us the keys, we will send you the net profit and a statement at the end of the quarter. We'll make sure you maximize your tax deductions. We'll make sure that you're getting maximum rent because we built a rental pricing algorithm, and our technology will make sure your bills are paid on time and your rent is collected on time, and a litany of other things we do. The other thing we've done, like I said, is we've changed the economic model. We work on a success fee. So rather than itemizing all of the costs that one would have to shoulder, a bookkeeper, a property manager, a rental agent, a lawyer, et cetera, we've combined it all into one product, and we do the work for a percentage of the rent we can collect. So if we can't collect rent, then we don't make money. So we've aligned our interests with that of the homeowner.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Most people who hire management companies are used to having to come up with some cash to cover shortfalls. When you put a property in your program, does the homeowner ever have to worry about you calling them and saying, well, we're $1,000 short this quarter, we need you to send us a check?
So what we do is we actually run a reserve account for each portfolio. So another differentiator is we're a financial company. So at the heart of it, we do have to operate some property management, but we also have insurance products and financial products and cash flow management built in. So instead of coming up with money when things shortfall, we actually hold some money in a bank account at the heart of the service. So we collect all the rents into that bank account. We pay out all the expenses on the home from the bank account. And if there is, say, like a repair, we would pull that money out of the account. If there was a very large repair, like a tree fell on the roof or something like that, then we might go back to the homeowner and say, hey, you've got this large expense that we need to cover, and they would have to reach into their own pocket. Our goal is to minimize or eliminate that under most circumstances.
You mentioned that Knox is a financial company. What's the distinction there? What does that mean?
There's any number of financial products that you need in order to run an income property. And there's any number that you might need in the future as you build wealth around income property. And we have some solutions today, and we'll add more in the future. So, for example, when you move out of a home to buy a new one, you might need some cash that's sitting in the home in the form of equity. And you might need to do a refi or get a HELOC. So bullet one, we have a mortgage function built right into our product. So we can find you that mortgage. Bullet number two, we know how to navigate the banks so that we get you the right approvals. For example, a lot of people don't know that if they have a lease in hand, the banks will treat that like income to the tune of about 75 cents of the dollar. So the right way to navigate with the bank is find a tenant, sign a lease for a future move-in date, then go get qualified for the mortgage on your next home, because now it looks like you have more income versus just walking in with your W-2 and having two mortgages against that. So we walk our clients through that. And if you think about what a financial advisor does, a financial advisor has any number of products they can offer you: stocks, bonds, mutual funds, etc. And it's all about helping you build wealth. And at the heart of it all, there's a bank account. And we very much operate the same way, only the assets aren't stocks and bonds and mutual funds. The assets are homes. Another example is insurance. A lot of people don't know if they have the right coverage. They don't know how to shop for insurance. We have an insurance brokerage function built into the business. So we take the homes to market. We make sure they have the right coverage. We can help. If you have multiple units, we can help pool that. We can help you get discounts on all sorts of insurance products. And that affects the net cash flow on the homes. We have another product in the financing side of things through a partner called HomeTap. Some people don't want more debt, but they are willing to sell a portion of their home in order to have the cash they need. So we actually are partnered with a company that will buy a percentage of your home and sort of take the ride with you. There's no payment to be made. That's not debt. It's actually they're buying a piece of your home, and if you sell it in the future, they still own that percentage of the home. So sometimes that financing works better for people because they don't want to have the impact on cash flow that debt financing does. And we will build in more and more products in the future, again, all based around the home and the equity in the home and the cash flow on the home.
So are you taking a financial stake in the property as well, or are you signing just a traditional management type contract with the homeowner?
We do not take a financial stake in the property itself, so we don't own a piece of it. We take a piece of the rent we can collect. So a traditional property manager would say, okay, your rent, your gross rent on the property is $100,000 a year. We're going to charge you 8%, so that's $8,000, right? That's not how we work. We say, hey, if we collect $1 of rent, we're going to take 10% of it, let's say, and that's it. So we're not going to charge you a brokerage fee. We're not going to charge you a lease renewal fee. There are no other fees. There are no itemized fees at all. So, like I said, it's different than a traditional property manager, but we only take a stake in what really matters to the homeowner, which is occupancy and collected rents.
Yeah. Well, I'm having trouble wrapping my head around the benefit to you and Knox, because if you're just charging a traditional 10% fee, but you're going the extra mile to provide all these extra special services, not just full service management, but you're also looking at all the other components: insurance, debt, financing, those things. Yeah. Where are you making the profit to justify all these additional services?
Sure. So when it comes to the other financial products, the market actually pays us for that, not the homeowner. So if we were just an insurance brokerage, like insurance brokerages make money, but they don't make it from the person who's being insured or the person who owns the property, they make it from the insurance company, right? So insurance companies pay us to bring them the policies to write. And so we make money on that. When we help somebody refinance, banks pay us. So that's part of it, number one. Number two, what also happens is because of the software we've built and the automation we're able to put in place, an awful lot of the services we deliver are actually built on the back of software and therefore become rather high margin parts of the business, as opposed to traditional property managers often need to put man hours into doing these things. And we're minimizing that, and we'll continue to optimize our process so that the decisions and the processes are run by software rather than feet on the ground whenever possible.
Well, that's all interesting. Now, Knox Financial, you guys are located in Boston. Is that primarily where you're providing this service?
Yeah, we launched a pilot in Boston. That's where we are now. We do plan on going out into other markets later this year.
I'd like to kind of switch topics here and talk about some of the articles you wrote for Forbes.com.
Yeah.
And there's two in particular that I think would be very helpful to our audience. One of them is called 5 Ways to Maximize Investment Property Returns. And the other is How to Avoid 6 Common Rental Property Pitfalls. You come up with some pretty unique items here. Why don't we start with the 5 ways to maximize investment property returns?
I'll start at the top. And one of my favorite things to maximize returns is I'm a huge believer in interest-only debt. And this is a little contrary to how a lot of people think about property. I've even had people tell me, hey, listen, the way to make money on property is have net cash flow and then pay down your debt over time. And now you own the building free and clear, and your net cash flow goes up even more. And I look at them and I go, you find me a piece of property that you've owned for a long term where what you bought it for is not a de minimis percentage now of its value, right? And of course, every piece of property they own and have kept for a long time is in fact worth many multiples of what they bought it for. So to me, paying down principal is actually not that optimal if you're investing in the right way. Investing in the right way means you have a long-term view. You're not over leveraging the property, which we would never recommend, and I would never recommend to somebody. And you feel like you've made an investment in an area that has a lot of security in the long term. And by the way, this could be 90% of the downtown markets in the 50 biggest cities in the U.S. You can look at a long-term investment and say, yeah, it's going to grow in value. So the hardest time frame to make a property cash flow positive is the first few years, say the first 5 or 10 years. And during that time, I highly recommend to people that they get an interest-only loan. It'll lower your carrying costs. And then if you just sort of assume a normal 10-year arc, you're going to find a few things happen in that 10 years. Number one, your rents will go up. Rents do generally go up if you have a long arc, and right now they're going up pretty well. Number two, the value of the property will go up. It's highly likely that you'll be able to get very different financing in a few years. And finally, you're going to have a few years, maybe even a decade, of even more positive cash flow. And now you'll have more say war chest to invest in the property and make it a well-performing asset if it has certain things that need to be done, like if you need to replace the roof or the major systems, and you get that all shored up, and now a few years in, you've got a property that's a lot more stable and you've de-risked. So that's one of the number one things I tell people.
So let me push back a little bit on that, because I don't necessarily disagree with you about the principal pay down during that period, and definitely in an appreciating market, your strategy makes a lot of sense. But what I've never seen, and you'll have to tell me where to find this, is a residential loan for rental property where you can pay interest only.
Oh, I have one of those notes on the property I own. So
that's one of the products that you have access to?
Absolutely, it is. I also own some income property of my own. Actually, this property that I'm talking about is in the Knox program. And I have an interest-only note on that property. So you can absolutely find it with banks and other lending institutions. If you called up Wells Fargo right now, just to pick a bank, right, who does a lot of lending, and you were buying property, you could very likely say, hey, what's the interest-only product look like? You're not going to find it in 30-year term. You're going to find it in 5 or 7 or 10. And you're going to find that when you take out that principal payment, the monthly payments surely go down. Also, in today's debt market, shorter term notes are less expensive the interest rates are lower than long-term notes. So right there, you're just going to also get, less of an interest payment as well. The other thing I find sort of a travesty sometimes is that people end up sitting on properties that have a lot of equity. And yeah, the equity is now growing in a 1-to-1 ratio with the value of the property, right? So if I've got let's say I've got $300,000 in equity on a $600,000 property, and I've got I've got half of it on debt, right? That $300,000 is kind of just sitting there. Whereas if I pulled it out and I invested it, and I could beat the interest rate again that I was paying against it, the overall investment return on my money would be performing better, and my rate of return would be better. So without advocating for a lot of debt, I would say you could easily pull, say, $100,000 out of that property and go and invest it in something that was even safe, but got you a better rate of return than the debt was costing you, and you'd net out better. The other thing I would do, and I'm sure you have a bunch of investors who are listening to this podcast who also have other assets. What you'll find is that a lot of the banks that are holding your other assets, and when I say banks, I mean like investment banks. I'm talking about the UBSs and Merrill Lynch's of the world, the Bank of America's of the world that have brokerage arms. If you have some assets there, it unlocks a bunch of other lending product that's interesting. And I'd highly recommend that if you're looking at debt or refinancing, if you're looking at debt to buy or to refinance what you have, call that institution and see what they're going to give you, more or less simply because you're a client of the institution and they have assets under management.
Yeah. So what are some of the other techniques to maximize investment property returns?
Yeah. So one of my favorites is add a bedroom. If you have a property that has the space to add additional bedrooms, you'll generally find that in the identical square footage, let's say you've got a 2-bedroom, you turn to a 3, or 3 and you turn to a 4, you'll find other units in the market with the same square footage, of similar product quality, with that number of bedrooms, and they're renting for that much more because another bedroom adds that much more value. I can't tell you how often I walk around a property and I'll go, oh, if we put up a wall there and put a door there and a closet over here, this just became a 2-bedroom or 3-bedroom. I once turned a 2-bedroom into a 4-bedroom. It was a 3,000 square foot 2-bedroom that turned into a 4, and the difference in revenue opportunity is enormous.
Nice. So add a bedroom. What else you got?
Well, yeah, just to go a little bit deeper in on that, what you find is if you're buying property that was lived in as a primary residence, or heck, even not it just wasn't rented out before, the previous owner is living in it in a certain way. The previous owner is optimizing around their lifestyle. To walk in and assume that home is going to be optimized for their lifestyle and optimized for renting to the general market is a little foolish, and often they won't fully align. So I would say beyond just adding a bedroom here and a bedroom there, look around and figure out, is the space actually being used well? I've seen properties with enormous laundry rooms. I've seen properties with, kitchens that for some reason somebody put up a wall that really shouldn't be there. That'd be much, an open kitchen would be, incredibly more attractive. All you're doing is removing the wall. One day somebody took out a door here. No, this could be a bedroom, that kind of thing. So I think walk around the property and think about it as, well, what is the market really looking for right now? And if you don't know, ask somebody, find an expert, and then put in usually it's not an incredible amount of money, but upfront before you start renting it, put in the investment. Hire a contractor, get them in there, and make the place what the market wants.
Yeah. What about taking photographs? Should I just buy a decent camera and take the photos myself for marketing purposes?
That's a great question. So one of the things we do at Knox is we have a professional real estate photographer come into every unit and make the place look amazing. Real estate photographers are kind of magicians. They can make a home that you're living in right now look better than it ever did while you're actually living in it. It's pretty amazing. It's a combination of having the right equipment and the right lighting and decluttering, and they'll literally, in 20 minutes, just make a room look dramatically better and more inhabitable. And studies have shown that homes with professional real estate photography sell for 5 to 10% more and rent for 5 to 10% more than homes that have not been, that are just shot with by an amateur. And unfortunately, an awful lot you see, they're just shot with an iPhone.
Mm-hmm. Oh yeah, you see those iPhone shots that are vertical in a dark room with a bright light coming through the window.
Right, and they shoot the front yard 4 days after a snow, and it's kind of muddy, and there's kind of piles of snow and a half melted snowman, instead of maybe waiting a day or two, or maybe getting ahead of the game and shooting it while it looks really nice and beautiful and white, or what have you. So photography is so critical. We include this with our platform, and very, very few rental brokerages or property managers actually send in a professional photographer. If you're renting your own, it's an upfront investment. You can almost think of it as a capital expenditure, because once you've taken those photos, unless you do a dramatic remodeling of the home, they're good for the next dozen or even 20 years. If you do a reno, take new photos again, but for a few $100, it's going to pay for itself, in a few months of rent. And you've got those photos to get top rent for the next decade or more. So it's a smart investment.
So what about pricing your rent appropriately? What's your take on that?
I can't tell you how many property owners I sit down with who have no idea what market rent should be for their unit, and or they know they're charging below market rate. They know. It's actually laughable to me. I've sat down with people who own millions in real estate. I sat down with somebody who owned 5 multifamilies recently, and the owner said to me, once I have a tenant, I don't raise rent. I said, can you say that again? Yeah, I just don't raise rent. So long as you pay on time, I don't raise rent. I said, okay, well, I think there's an opportunity there. But sometimes it's not as severe. I sat down with another fellow, and he said, he had maybe a 3-family and a 2-family, and he said, well, this property here, I was going to raise the rent last year, but I just didn't get around to it. And the tenant's been really good and really on time, and I never hear a peep from them. So I'm okay with it. I could probably get another $300 a month out of them, but I just didn't. Maybe next year. Now, next year, he could probably get another $400 for the unit. If he walks up to his tenant and says, hey, I'm jacking your rent $400 a month, the tenant's probably going to have a conniption. So a lot of people don't have they're not comfortable with having a conversation with their tenants. They have a relationship with this person. They're doing self-management. And now it becomes hard to, even do something as small as, say, a 2 or 3 or 4% rent increase. It's almost like asking your friend for money. And that's one of the things that having a professional in between you and the tenant gives you. I can't tell you how often I see this. So the other thing is, there's now a lot of data. You have to license these data sets and use it to price homes accurately. Yes, you can go out on Craigslist and search Zillow and see what Zillow says and see what else things are renting for on the market. But you're really better off if you have a true data set. And that's what we built our pricing algorithm here at Knox on. So we've licensed a data set and built an algorithm based on that. And even then, you have to go into the unit and see the finishes and what else is available. Does it have parking, et cetera? And then you sort of take the algorithm and then you add a little bit of a human element on top of it, and now you can accurately price it.
Okay. Great advice. So I know we're both a little pressed for time. But I do want to talk about the how to avoid 6 common rental property pitfalls. And there's one in particular that I'd like you to comment on, and I'll just list the others here. These are some of the pitfalls: skipping tenant background checks, collecting your rent by check, mismanaging security deposits, going off lease. But the last one here I thought was really interesting, and especially, we're in Grand Rapids, Michigan, you're in Boston. Number 5 here is letting your basement freeze. Talk about that. Why is that a mismanagement pitfall?
Oh, man, why is that a mismanagement pitfall? It's really more of a comment about proactive maintenance. There's no reason that a basement should freeze. There's no reason a basement should get overly damp either. The idea is a lot of people want their properties to be set it and forget it, and that's a nice idea. If you put in a lot of investment up front, they can be that for several years. But it's important to know when your hot water heater is probably past its useful life. It's important to know when your roof should be replaced. And it's not a good idea to wait for the heating system to die when it's 10 below in February. It's a better idea to know that the heating system is at the end of its useful life. Let's replace it now. Let's do it. Let's plan it. Let's get the rebates we can from the energy company. Let's let's get the regular rate from the HVAC company rather than the emergency rate. So now it doesn't cost you an extra few grand more. So preventative maintenance requires you to know something about your property and be a little bit more organized than reactive maintenance, which is what so many people do. Great advice.
And I'll just make a quick comment about number 6 here. This is your 6th tip on avoiding mismanagement pitfalls. It's not hiring an accountant. And we've talked about this before on the show. I mean, I think it's so key to have bookkeepers, accountants, CPAs helping you with your financials, because this is a business, and it's important to treat it as such. But anyway, I know we need to wrap this up. Do you have any final comments for our listeners?
Two small things. One, on the not hiring an accountant. I can't tell you how many people I sit down with and they say, yeah, I'm just not good at tracking my receipts, and I meant to open up a separate bank account, a separate credit card, and have it all. No, I haven't done that. So they're missing out often on thousands of dollars in write-offs a year. Anyway, final words. I think the answer. My final words are: I think people who are trying to DIY their own rental management, if you dot every I and cross every T and you avoid the pitfalls, you can maximize your investment. It's absolutely the way to get the best out of your investment if you can do all those things well. If you can't, we've written a set of articles. They're on Forbes. We sort of give you a step-by-step. Try following them, and we hope they bring some value. And if not, maybe you talk to a professional if you don't want to handle all that yourself.
If someone wanted to get a hold of you, how would they do so?
We're at knoxfinancial.com. You can check out what we're up to and contact us, and we'd be very happy to chat with you.
Well, David, thanks for sharing your experiences with us. I always love talking to entrepreneurs, and you've definitely created some really interesting companies and successful companies. What you're doing with Knox Financial is very unique and different, and it was great learning about it. And I especially enjoyed hearing your tips on maximizing your income and avoiding some of those landlord rental property pitfalls.
Brian, this has been great. Thank you for having me on, and I hope to be on again sometime in the future.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.